What's the key to outperforming professional investors? In this 6th video of the Muslim Investing 101 series, we'll find out. Fees are sneaky. That is the third mental shortcut we need to memorize in the world of investing, and our action item is to find the number, to sift through the paperwork, maybe to ask the question. In the world of investing, small fees are in fact huge. What might seem to be a nominal fee actually adds up to be quite a bit. Imagine $1,000 invested for 30 years. If we kept that cash after inflation, we'd have $253,000. If, however, we invested it in a high fee investment fund where the fee was only 2.5%, we'd have quite a bit more, 1.1 million, and that would be great. But if we invested in a low fee investment fund with the same return, then instead of 1.1 million, we'd have 1.6 million. Remember that the difference in fee was only 1.5% between the high and the low fee investment. But the actual dollar cost difference between the two is over $500,000, $550,000 lost to fees. And the thing about this is that $550,000 lost to fees is entirely avoidable. You need to remember two types of fees. The first is what is known as an assets under management fee, and the second is what's known as a management expense ratio, or MER for short. The AUM fee is a percentage of your total managed assets that you pay to an investment manager for their services. This is what you pay when you hand your money over to someone else to manage on your behalf. It's what people who use professionals will pay. It's what people also in the passive investing world will pay to robo-advisors. Your management expense ratio is different. It's the percentage that you are charged for accessing a fund. It's sort of the cost annually for accessing the market. The thing to take away from this is that AUM fees are avoidable, whereas MER fees are not. So AUM fees are avoidable, MER fees are not. The goal is to get the lowest fees possible. So you have to look at both your AUM fee and your MER, and that will be your total fees. Aim for under 0.5% in total fees. It's not always possible, but that's the goal right now for Muslims investing in the market. It's 0.5%. So remember, fees are sneaky. People will often try to pass it off as inconsequential or nominal or the cost of high performance. But because compounding is so weird and there's this exponential growth attached to it, a small difference between two fees will make a big difference. So aim for under 0.5% right now in total fees, and you should be okay, inshallah. Our fourth mental shortcut in the world of investing is professionals underperform. Do not drink the Kool-Aid. Once you begin talking about investing, a number of people who claim some sort of professional edge in the space will claim to be able to provide excess returns, meaning that they can outperform the market as a whole. They can outperform passive investing. And we've already covered this earlier in the course, but I think it's important to really drive this point home, which is that professionals, generally speaking, will underperform the market as a whole. This point was highlighted a few years ago when Warren Buffett put out a challenge to hedge funds. He was going to put in money in the S&P 500, meaning he was going to passively invest in the stock market, and he was going to see whether or not any hedge fund, so these are active managers actively trying to beat the market, would beat the S&P 500, just the whole market, over the course of about 10 years. You can see that this was actually a bet. They put up a couple of $1 million at stake for charity, and what ended up happening was all of these funds underperformed the market itself. Now, these were people who were actively trying to beat out the market. This was the number one goal over this nearly 10-year time period, and they weren't able to do it. And these were professionals, but they underperformed the market. And of course, the winner ended up being Warren Buffett. We've shown this before as well, which is that on a year-to-year basis, active managers in large percentages underperform. Another way to put this is, rather than going with an active manager, you had a far better chance of doing well if you had just followed the market as a whole. Now, there will be people who will claim that their mutual funds or that their active management is better than passively investing in, let's say, an index fund. There are two things to keep in mind when you hear that. The first is that historically, yesterday's winners will be tomorrow's losers. And so even if an active manager is winning against their benchmark, they are likely to begin to lose in the future. And so if you really wanted to find a winner, you would have to look through the large number of losers to find a future winner. The second thing to note is that if you are ever shown a list of a firm's successful funds, you have to remember that yesterday's losers are often hidden. They will remove all of the losing funds and just show you the winning funds. We call this survivorship bias. The big thing to note about investing in general is that efforts and results are not correlated in investing. Unlike other avenues of human endeavor, when you begin to exert more effort, the results improve. In investing, that's not the case. And there's a bunch of reasons for this, and part of it is this theory called the efficient market hypothesis, which is beyond the scope of this course. But it's important to note that just because somebody is spending more time and putting in more effort into their investing, the results are not correlated to that effort. And so you can outperform professionals by simply buying the market. This video is part of the Muslim Investing 101 series. Be sure to check out the entire playlist. And if you find the videos on this channel beneficial, please like, subscribe, and share.